Hey everyone, welcome to the DSO Study Club, groupdentistrynow.com. This is our webinar series. Sorry for the couple of minute delay there. We had some technical difficulties, but we are good to go here. And had a lot of great questions that came in from everybody that registered ahead of time, and Chip was working feverishly yesterday to put together the answers to these questions. So he's going to answer a lot of those questions ahead of time. And then if you have any questions during the presentation and Chip can't answer those live, you can reach out directly to him, or as long as you're not, asking the question anonymously, we'll know who asked the question and Chip can follow, or somebody on his team can follow up. But the other thing is this will be recorded, so you'll be able to access this video tomorrow, this webinar tomorrow. But Chip is going to kind of go through everything that's happened as far as valuations, what 2025 looks like. I know there's a ton of questions about private equity investment. There's a lot of questions about valuation for GPs versus specialty. A lot of great questions came in. So I'm going to turn this over to Chip because he has a plethora of information and a lot of slides to get through. And yep, Chip, can you see if you can access that presentation on your side?
How's that?
All right, Chip, I'm going to let you take over and then I'll monitor the questions here. And if anything comes up that we want to kind of stop and answer the question live, we can do that.
Fantastic. Thank you, Bill. I appreciate it. And thank you for joining us, doctors. Live webinars are always entertaining with the technical challenges that come in early. So what we're going to talk about today are practice values in my world, and my world is invisible dental support organizations, of which there are 1,000 in the US today, and you would have heard of many of them. But the invisible DSOs have been around for 35 years, and they received over $8 billion of new investment last year. And so they are eagerly out there contacting any larger practice and attempting to get you to become their partner, which we think ultimately, if you choose correctly, is a great opportunity for doctors. And today, the values are still achieving records for certain types of practices. And we'll talk about what those are and what elements will help make a practice more valuable. But a little quick story on large practice sales. We've been around for 8 years. We've done billions and billions of dollars of transactions. And fortunately, not just in initial values, but we'll talk a little bit about some of the recapitalizations that occurred last year that dozens of our clients were able to participate in and help monetize more of their practice values. Let's see, Bill, is this going to advance? There we go. Just a little slower. Okay. Our basic belief is that if your practice is big enough and it's qualified and it's growing, that an invisible DSO partnership is going to be more valuable for you long-term and short-term than remaining independent. And we'll go into the reasons as to why we believe that in more detail momentarily. But a quick note, and I'll mention this in the presentation, but of the $1 billion of transactions that we have completed, or IDSO partnerships, in the last 24 months, $150 million of that have been for doctors in their 30s. This is not a retirement strategy. In fact, if you are eager to leave soon, this is not a strategy at all for you unless you have multiple young associates. Quick look at our advisory board. I think we're one of the few groups in the country that has a 4-star admiral on our board and a member of the American Dental Association, Dr. Andy Brown. We did a great transaction for him. And Dr. Davidson is a little busy helping his friends in the Navy at the moment. He was former head of Indo-PACCOM, which is in charge of 384,000 people, Army, Navy, Air Force, Marines, DOD, CIA, everybody in the Pacific and Indian Oceans reported to him. So other advisory board members that we have include Mitch Olin, who is the co-founder of one of the largest invisible DSOs in the US that he joined 30 years ago. Dr. Todd is an implant guru and has been instrumental in helping us help implant and all on X focused practices achieve high values. And last but certainly not least is Bhavik Patel, who is one of the foremost tax experts in the US and helps us structure our practices or our clients' transactions for the best tax outcome. Unlike everybody else in this business, we only do dental. And frankly, we have a hard time keeping up with dental with 35 people that help us do that. But it's been a great time to help doctors monetize their practices, given the values that we've been able to achieve for them. So your questions answered early. I think Bill's strategy of getting questions in advance is fantastic. And so I scrambled around and rebooked my presentation so that I could get some of the key questions answered early. We'll answer them in more detail later, but one of those questions is, how are interest rates impacting practice values? The answer is it has not impacted practice values. We've been still getting record values for our clients, but it's coming from those groups that are not on what we call the blacklist. The blacklist are the 900 invisible DSOs that we won't allow to bid on our clients for a variety of reasons. And one of those reasons may be that their only source of capital is bank debt, and bank debt is impacted by high interest rates. But fortunately, there are dozens of invisible DSOs that are not reliant upon bank debt and therefore not impacted by higher interest rates. So the answer is yes, bank debts or interest rates are a problem, but not necessarily for the bidders that we would bring to the party. One of the questions was, what kind of values do you achieve for practices? And the answer is, in the last 6 months, we've achieved values between 6.75 times EBITDA and 11.25 times EBITDA. And we will break that 11.25 EBITDA on a deal that's closing next week at a little over 12 times EBITDA. The cash versus equity component, our clients will typically see bids that have 51 to 75 or 80% cash in some cases. And again, it depends on what the doctor wants. We find that the younger doctors are eager to take more equity and less cash because they're interested in the equity upside over time, which can be very valuable if you have a long-term view of the world. Doctor compensation is pretty easy. Doctors are going to be compensated at what I call replacement cost, meaning what it would cost in your market to replace you. In ortho, that will often be a salary or a day rate. In everything else, it will be a percentage of collections. That number is negotiable, and that number has a direct impact on the initial value that you receive. One of the questions was, are deals taking longer? The answer is yes, but not that much longer. I hear some of the shaky invisible DSOs out there stringing doctors they have under letter of intent for months, or even in some cases over a year. That is not a good sign. That means it's probably not the right partner for you. We're typically getting transactions completed anywhere between 45 and 90 days of signing of a letter of intent. And one of the interesting things about the equity that you retain in one of these partnerships is that it can be retained at the practice level, the parent level, or a combination of both. And contrary to popular belief, you do not have to wait for your new partner to recapitalize for you to be able to liquidate your equity. We've done well over 100 of these partnerships where the doctors had a defined exit date at a value that was pre-negotiated and typically based on the last year of the doctor's ownership of that equity. But you can absolutely do a transaction where you have a known exit on your equity without having to wait for the much promised big recapitalization event. So our value partnership ranges in 2024. Lowest transaction we completed was at a value of 2.9 million, and the highest was a single office GP at 62.5 million. And again, the lowest EBITDA multiple was 6.75. And many of our transactions, in fact, over 150 million just in the third quarter last year, achieve values in excess of 300% of collections, which is not how we value practices, but I know it's how many doctors think of practice value. And the answer is, in an invisible DSO partnership, your practice will be valued based upon its EBITDA or operating income. And remember, when you go back to ask your CPA, what is my EBITDA? Make sure he factors in appropriate compensation for you, because EBITDA is after doctor compensation. Again, whether you're a GP or a specialist, the multiples are all relatively close. The things that make a difference are geography, growth rate, age of the doctor, procedures performed, and payers accepted. So let's talk about what kills practice values. Because if I were a dentist and I had a practice today, the number one thing I would be worrying about today is, will my practice collections decline if we enter into a recession or some other type of economic calamity? And just by watching CNBC or reading the paper, you can see that economic calamity may not be too far away. And in our world, if your collections decline during the process, you become functionally unsellable at any price in an invisible DSO partnership. Certainly, you can still do a doctor-to-doctor transaction where you might be valued at 80% of collections if your practice isn't too big for that doctor to finance. But in my world, the big fear that any doctor should have is, will the economy impact my practice such that my collections decline? Because if they do, then you really can't do a great invisible DSO partnership, and you'll have to wait until you have exhibited at least 6 months of positive growth before we can start the process again. So make sure you're growing, stay growing, and be aware of what happens if you don't. I'm going to give a quick little economic view of the world. This is not my view of the forecast. This is what dentists think of the current economy. This is what the US consumer thinks of the current economy. And this is what the price of gold has done. For those of you not watching it, it hit a new high of over $3,500 a couple of weeks ago. And I consider gold to be the global fear gauge. And if you're not globally scared right now, you're probably not paying enough attention. But gold is always telling the world what's going on. And as you can see, it's up over 40% just this year. So the other risk that I think doctors should be understanding is the legislative risk. If you are a practice in Oregon, I'm very sorry to tell you that on June 9th, the governor of Oregon just reduced the value of your practice significantly, because they just enacted legislation that will change, in essence, the rules for professionally backed groups partnering with doctors in the state of Oregon, such that you're going to have very few invisible DSOs eagerly bidding on practices in the state. And I hate to be the bearer of bad news, but similar legislation is currently in process in all of these states. Now, whether it'll get passed or not, I don't know. California had a similar bill sitting on Gavin Newsom's desk in September of 24, which he fortunately vetoed, but it would have functionally eliminated invisible DSO bidders from the state of California. There's a new version of that bill currently winding its way through the morass. But you need to keep an eye on this stuff, because if regulations like were enacted in Oregon on June 9th come to your state, it can functionally render your practice unsellable in the invisible DSO or DSO world. Certainly, you'll still be able to do a doctor-to-doctor transaction, but now we're talking 80% of collections, not 300% of collections. Big value drop. So you should pay attention to what's going on in your state capital, and you may want to get involved. And if anybody's going to raise money to fight those regulations, please feel free to call me, and I'm happy to donate. Consolidation is accelerating. Part of the reason younger doctors are participating in invisible DSO partnerships are they're realizing that invisible DSOs are not necessarily like DSOs. A traditional DSO is going to be interested in buying 100% of your practice, homogenizing it to fit their corporate standard, and telling you what to do and how to do it and when to do it. The invisible DSOs are not like that. We'll talk about why in a minute. But today, the most consolidated of all practice types is ortho. Fastest consolidating is oral surgery, due to the recruiting challenges. In June this year, 230 graduates from residency, 125-ish of those will be going to invisible DSOs and DSOs. 25 are going into public service, And the balance are available to be recruited by the 5,000 independent oral surgery practices that are desperate to recruit today. It's very tough. So with that many going to invisible DSOs, the doctors whose ultimate dream was work to 55, hire an associate buys them out, they go play golf. That dream is pretty much gone. So if you're an oral surgeon, start thinking about your future in your early 50s, not your late 50s. Now, the things that drive value in 25 are really no different from 24. However, in 25, because so many practices are eager for invisible DSO partnerships, more so today than any time previously, the invisible DSOs have more practices to choose from. And obviously, they would prefer to have growing practices, the faster the better, with younger doctors, and they're being more selective. So it's a good time to understand the value of your practice today, because there's $8 billion of fresh financing and capital that went into the invisible DSOs in 2024, and that capital needs to go someplace. And we would like it to go to you at a very high value. Now, we'll talk about the big recaps of 24 here in a second. And there's a couple more that are in process that will close and announce here in the next 30 to 45 days. But recapitalizations are happening. That was one of the questions. If you have a quality asset, the definition of quality asset is organic growth at the partner practice level. The value of an invisible DSO in a recapitalization is based upon not just how many new practices they were able to partner with, but what value were they able to bring to their existing partner practices. Now, a lot of doctors are of the belief that to get to high value, you need to have multiple offices, and this is not true. In 2024, our highest value deal was over $62 million for a single office GP. And in 23, our highest value transaction at 43 million was for a single office multi-specialty group in the Midwest. So having multiple offices does not necessarily translate into high values or high multiples. And in fact, in many cases, multiple offices will reduce your margins and reduce your EBITDA, because it's difficult to support the overhead of multiple offices when a larger single office is often easier to manage than multiple little offices. So be careful when you think about that. And the interesting thing was our highest multiple in the last 6 months was 11 and a quarter, and that happened to be for a pedo ortho practice. And none of these transactions outlined on this slide were done in what we call the hot states. So the hot states are Florida is the number one hot state. We have, and I'll show you examples of this, but typically, if you have a great practice in Florida, it would not be unusual for you to have 10 qualified bidders to choose from. Texas is a very consolidated state. Arizona is popular. Utah and Idaho and Colorado are all attracting eager bidders. And really, probably the number 2 state after Florida today is Tennessee. One of the questions we had was, how do you sell a rural practice? The answer is, in my world, rural can be challenging, but it is not impossible. The typical definition of rural is if your practice is more than 60 minutes to a commercial airport. Hawaii and Alaska are possible, but definitely fewer bidders there than any other state. You have to excuse me looking away from the camera because I'm looking at the screen that I could move the slides on is to my left, so I apologize. Payer mix and procedures performed. Interestingly, because many of the invisible DSOs are getting reimbursed at higher rates from insurance payers than independent dentists, we've seen examples of heavily insurance-based practices that were eagerly sought by the invisible DSOs, because after looking at that practice's reimbursement rates, they looked at it and said, gee whiz, we're getting reimbursed at rates 10 and 15 and 20% higher than this doctor. So partnering with this doctor is a layup, because we can add 5, 10, 15% directly to the bottom line, because they're so heavy in insurance with the payers that we've been able to negotiate better reimbursement rates with. So being fee for service is great, because it enables you to keep your margin compression under control. When your costs go up, you can raise your fees. Not true necessarily with the insurance-based practices, but being an insurance-based practice is not necessarily a negative. Adult Medicaid is the kiss of death. Don't take adult Medicaid unless you absolutely have to. And if you do take adult Medicaid, we're not going to be able to help you. All of the groups out there today are extraordinarily afraid of adult Medicaid. That is not new. That has been going on for multiple years, pre-Biden, pre the first Trump. Adult Medicaid is a tough place to be. Pediatric Medicaid is fine. We really don't want to see pediatric Medicaid in excess of 50% of total collections. The biggest story of 2024 was the recapitalization of the largest invisible DSO in the US. This particular invisible DSO completed their third recapitalization in 7 years, and they increased their value from 330 million at their first recapitalization to over 3.8 billion at their third recapitalization in November of 24, which means if you, like some of our clients, joined that group in 2017, you saw the value of your equity over 7 years increase by 10 to 12 times, or 1,000 to 1,200%. So fortunately, we had dozens of very happy doctors who got to participate in this latest recap. And this is how everyone would like to see these transactions work out. Unfortunately, this particular group is now too big to replicate their early success. They're still a great group. However, the equity upside in this group will not be replicating their historical equity upside. But they do have the exact same management today as they had 7 years ago, and for that matter, 10 years ago. So choosing wisely, you don't have to worry about the management revolving door as you will in some of them. There's a little chart of what that recap looked like and the value increase over a 7-year period of time. Again, we had lots and lots of very happy clients there. This is a look at the U.S. dental services market, and this explains why $8 billion went into invisible DSOs in 2024. And keep in mind, that's the invisible DSOs, not the traditional branded homogenizing, micromanaging DSOs, but the invisible DSOs who want to partner with doctors who are eager to maintain their full autonomy, not just clinical autonomy. So here's an actual growth of another invisible DSO. The reason I put this chart up there is to look at the returns based on where they were in their development. So in the first 4 years, the doctors experienced a 10x return on their retained equity. In the next 7 years, it was only 2x. So sometimes getting in early, if you choose wisely, can be extraordinarily profitable. The key is you have to choose wisely. So these are the ADA's statistics. And even though one of our board members sits on the board of ADA, I think the ADA is often wrong. And I think these numbers, frankly, are wrong, except for average GP collections, average specialist collections, and the reduction in owners. So here's another view of dental consolidation. I don't know if you can see that on your screen or not, but according to a self-diagnosed belief that they were either a part of a DSO or an invisible DSO, 68,000 doctors self-identify as being part of a DSO or an invisible DSO. So it may be more consolidated than the ADA believes, but that's their researchers. So there's basically 3 different types of invisible DSOs. The first ones are the brand DSOs that buy 100% of a practice. The doctor continues to work for that practice, typically for some pre-agreed amount of time. Oftentimes, some piece of the 100% purchase is held back to make sure that the doctor sticks around and continues to produce at some sort of required level. And we don't do business with the branded DSOs, primarily because the values are lower, the doctors are not afforded full autonomy, and they're not particularly attractive to younger doctors, and our average age doctor is probably 50 today. The invisible DSOs, on the other hand, are eager to partner with doctors who want to maintain full autonomy, meaning the doctor is not only making the clinical decisions, but also making the management decisions within the practice. They're deciding who to hire, who to fire, when to be open, what procedures to perform, what payers to take, and whether to throw the company Christmas party at the country club or the community center this year. The invisible DSOs want the doctors to continue to do whatever has made them successful to date without interference from their invisible DSO partner, but they get the opportunity to benefit from their invisible DSO partners' resources, but they are not told what to do or how to do it. And that's an important piece of this puzzle, and it's an important piece of our process. And we'll talk about that in a second. And then you have a third type of DSO, which is growing primarily through de novo, where they're building new offices, typically common brand, not always. And these groups are not typically buying any practices or partnering with any doctors in the invisible DSO sense. So an invisible DSO differs from a traditional DSO because it's not a common brand. The doctors are owners in every case, and that ownership may reside at the practice or the parent or both. And the doctors have full autonomy. Whereas with a traditional DSO, it's a common brand, and they're going to tell you what to do and how to do it. And you really don't have any equity upside as a doctor. Certainly, in some cases, these groups will offer the doctors the opportunity to write a check and buy into the parent company, but those are usually nominal amounts. In an invisible DSO partnership, the doctor is going to continue to be an owner of anywhere between typically 20 and 49% of the practice value. Now, interestingly, over 90% of the new DSOs and invisible DSOs being formed are actually invisible DSOs. The invisible DSO model works because they don't have to micromanage their practice because they have an owner doctor who's making the decisions within that practice that they have partnered with. And statistics show that owner-run practices operate better than employee-run practices. Some people would disagree with me on that, but I think the fact that the invisible DSOs got $8 billion in capital last year certainly endorses the invisible DSO model. And in case I don't mention it later, the world's largest asset manager, BlackRock, today has invested in 4 invisible DSOs in just the last 30 months. So when the big money, not necessarily private equity, but the big money with 13 trillion in assets under management starts getting into this game, there will be others who follow. And in fact, sovereign wealth funds are now investing in invisible DSOs. And you have all types of other investors, and we've done hundreds of millions of dollars of partnerships with family office backed invisible DSOs, which we happen to like because there's usually one decision maker that makes a decision in about 30 seconds, whereas the private equity backed invisible DSOs are functionally run by committee, and it takes a long time to get answers sometimes. So your choice in invisible DSO partners is growing rapidly. 8 years ago today, there were no oral surgery only invisible DSOs. Today, there are 17, maybe 18. Ortho, they are now down to 13 ortho only invisible DSOs because the biggest one just bought one of the top 5. So they went from 14 to 13. The dental trifecta model, which is the groups that are interested in pedo, ortho, and oral surgery only in the same communities, still hold the record of the highest recapitalization multiple. A dental trifecta that we helped build recapitalized at a $2 billion value in the fall of 22, and that was done at 20 times EBITDA. So a win for the doctors and a win for the investors. And how fast are they growing? The answer is they're growing really fast. The good ones are able to add new partners at rational values and then add benefits to those practices such that the biggest invisible DSO last year was able to increase the EBITDA margin on their average 700 practices by over 5%. And it's that type of growth that is attractive to investors. Now, the benefits of partnering with an invisible DSO will vary based on the partner that you choose. Again, as I mentioned earlier, there are 1,000 or more invisible DSOs out there today. We consider less than 100 of those qualified to bid on our clients. But even those may be big, they may be small, they may be old, they may be young, but they're qualified. They have the right investors, the right capital, the right management, and the right strategy. But the invisible DSOs are going to leave you with full autonomy. You're going to have an equity upside in whatever ownership percentage you decide to retain. You may have synergies with partner practices. For example, if you are an endo and you partner with a group that has 25 GPs in your region, you may have 25 new referral sources that you didn't have before your partnership. One of the interesting things about the invisible DSOs that makes them very powerful recruiters is they're going to try and create a path to ownership for your existing associates and your future associates. Ownership is important to the invisible DSOs because it means golden handcuffs on their doctors. Once you become an owner, you're not leaving to go down the street for more money. And some of them are even being very shrewd and offering ownership opportunities to some of their key team members. And that's a great way to keep your hard to find hygienists sticking around without going down the street for an extra buck an hour. So ownership is very important in the whole invisible DSO concept. And if you choose wisely, they can be very helpful in how you grow your business. And I believe one of the primary reasons younger doctors are choosing invisible DSO partnerships is because they're beginning to realize that if they want to grow fast, rather than taking on bank debt or personal liability, the invisible DSOs will be eager to put up the capital necessary to finance younger doctors to either expand their existing practice, acquire competitors, build de novos, but they are all eager to finance successful doctors who have a growth plan. Now, being big gives you some great opportunities. Number one, your supplies expense are going to be 25 to 30% less, no matter what your local rep tells you. That is the truth. Your implant costs are probably going to be 50% less, sometimes more. And you may get up to 20% higher reimbursement rates from insurance payers. And again, this will all differ based on the invisible DSO that you ultimately choose. And in our bidding process, where our clients will typically see 5 or more qualified bidders, they'll get to ask these questions and compare these numbers. Hey, I'm taking Delta here in California. Are you getting reimbursed at higher rates than I am? And if so, by how much? Another thing that the invisible DSOs are leading on is the adoption of AI technology, particularly in the diagnostic processes, and that is fanning out to billing and to customer service. So the AI adoption is going to be important to profitability. It's going to be important to competing because when you're able to show a patient the problem in their mouth on a big screen, since they're used to looking at a 6-inch screen all day long, the big screen does not replace the clinician's intellect, intelligence, or training, but it can augment a diagnosis by showing it to the patient in a 42-inch diagonal screen, live color. Hey, by the way, this is a problem. We need to fix it today. So AI and diagnostics, talked about implants. And if you're not familiar with Curodont, you should look into it. It's an interesting new product out of Switzerland. Now, one thing to remember is that when an invisible DSO comes to your community, you have a very powerful competitor that is accessing professional marketing and they're accessing professional recruiting, and they can be very fierce competitors. In fact, if you're a specialist and an invisible DSO comes into your town and acquires your referral sources, it is possible that you will lose those referral sources. And so you need to be fully aware of what's going on in your community. And because an invisible DSO does not announce their arrival, nor do they put out a press release, the doctor down the street from you may have joined an invisible DSO partnership and you don't know it. And you now have a stiff competitor who's paying less and getting reimbursed more than you are. So give me a call and I'll tell you who's in your neighborhood and we'll go through the value of your practice. Age is very important. The younger you are, the more valuable your practice is. If you're over 60, I hope you have a young, eager associate who is actually doing the majority of the collections in your practice, or multiple young, eager associates. But the age is becoming a bigger and bigger issue. I'm 65, so I get to pick on old doctors. But it is important that if you are over 60, that you are a multi-doc practice and that those other doctors are younger, unless you're an oral surgeon. And if you're an 80-year-old old oral surgeon, I can probably get you a deal because you're rare. Benefits for younger doctors. One of the things that I believe is why younger doctors have chosen invisible DSO partnerships is because during the COVID shutdown, they got to stay home with their kids and see what life is like at home rather than having a drill in their hand all day. And so I believe that many of the younger doctors have elected to offload some of the administrative minutia to their invisible DSO partner so they can spend more time with their young families, because this is time they're not going to get back. The invisible DSOs will take over banking, accounting, payroll, benefits administration, compliance, credentialing, tax, legal, IT support, and vendor and payer negotiations. When it comes to vendors, they're not going to tell you what products to use, but they may be able to help you buy the products that you like at a lower cost. And the interesting thing about younger doctors is they may be able to get to experience what our dozens of clients did in that recap of last year. Or had you started with $1 million in equity and your partner recapped 5 years later and increased the value of your equity from $1 million to $3 million, and then recapped again for the second time 5 years after that, that $3 million became worth $9 million. And if you're still around for that third recap of total of 15 years, year one became 3, which became worth 9, which became worth $27 million. And if you think this doesn't or hasn't happened, it has, and call me and I'll be happy to show you examples of even larger returns than that. Now, the structures for young doctors can be very flexible because the invisible DSOs are eager for you, so they're going to bend as much as possible to get a younger doctor. One of the things that I always tell doctors is sometimes the accountants are not as smart as they think they are. And we have seen multiple clients get told by their CPAs that they owe the Obamacare tax of 3.8%, just as they might pay on their securities investments in their brokerage account. The reality is the Obamacare tax does not apply in these transactions. So don't let your accountant convince you otherwise, because they're wrong. Now, associates, many doctors say, well, I want to make sure my associates and my team members are excited about this. Well, the answer is many of them have heard horror stories from their friends and colleagues that have joined DSOs or the wrong invisible DSO. And those horror stories, unfortunately, are true. So one of the things you're going to face as we go through this process is making sure that your team and your associates understand that you're going to choose the right invisible DSO and that life is not going to be worse for them. It's actually going to be better. And the way we do that is when a doctor gets down to their final 3 bidders in our process, we're going to introduce our client, the doctor, to other doctors that have joined that particular invisible DSO, and they're going to get to have a doc-to-doc conversation and ask questions like, what changed, what didn't change, are you glad you did it, would you do it again? And most importantly, did your invisible DSO partner do what they said they would do? And we can set up those conversations for your office manager and your team members and your associates, because we want you and them to fully understand what's going to change and what's not going to change. Our clients go into these transactions with their eyes wide open because of a very extensive education process about the actual partner that they're going to join. And ultimately, in our process, if we don't find you a partner that has the right cultural fit or the right value, you're never obligated to do anything, and we get paid a total of nothing. So it's valuable to at least go through a process of understanding the value of your practice today. Now, number one myth dispelled is autonomy. This is the number one concern that every doctor has is, well, I'm afraid that if I do this, they're going to come in and change things and make my practice different. We're going to lose our culture and I'm going to lose my great team members. The answer is that is the exact opposite of what the right invisible DSO wants to happen in your practice. In fact, it's the opposite. They're going to offer paths to ownership for your associates such that they don't leave. And they're going to offer opportunities to your team members that they don't have today for advancement, for additional income opportunities. And in many cases, the team members' benefits will be better at lower cost. And in no case will their benefits be worse than what they are today. So helping the doctors understand that they have full autonomy and that they contractually have full autonomy is very important. Now, the doctors with full autonomy are going to decide who to hire, who to fire, what to pay them. Now, certainly they'll be able to access their invisible DSO partner to help them recruit. Some of these groups will have 24 full-time in-house recruiters helping their partner practices recruit everything from front desk to associates and everything in between. So you're going to get to choose what supplies you use. You're going to get to choose what labs you use, but you're going to get help. Now, EBITDA, this is the big scary number, and nobody really understands what it is. And frankly, it is an art, not a science. But what it stands for basically is functionally the cash flow from your practice after adding back interest, taxes, and depreciation and amortization. EBITDA. And it's pronounced a lot of different ways. And frankly, it's calculated a lot of different ways. And every group has a different way of calculating it. And I always laugh at the doctors who say, well, I talked to Acme DSO and they made me an offer. And I said, well, what was your EBITDA? He said, well, they said it was X. And I said, do you know what your EBITDA is? Or are you just being told that's what your EBITDA is by the guys who are trying to buy you? Well, that's what they told me. I'm like, well, guess what, doc? Whose interest do you think they have when calculating that EBITDA? Are they calculating it to your benefit or are they calculating it to their benefit? And the reality is EBITDA calculation is very different. And I'll give you a good example. We had a client that was doing 4,000 implants a year. They were paying $280 for a very expensive implant, but they thought they had the best deal in the country. The Invisible DSO partners were paying $110 for that same implant, so $170 delta across 4,000 implants was a $680,000 immediate EBITDA impact upon partnership. And since this was a 10x deal, we managed to get that doctor an extra $6.8 million because we knew the Invisible DSO that would give him credit for the cost differential between what they were paying and what he was paying. So understanding how the Invisible DSOs calculate EBITDA is extraordinarily important, and never, ever, ever let your potential partner calculate your EBITDA because they're not going to do it to your benefit. Now, in our world, if you don't have multiple bidders, you're leaving money on the table. But more importantly, you're not getting to see all of your options. Again, and our clients will typically have at least 5 bidders, some many more. But the key to a bidding process is not just about getting a higher value. It does, but it's about understanding who you want to spend the balance of your career with, because all of them have different cultures and different support services, and you need to understand all of your options. So here's an example of 2 clients, both happen to be in Florida, 18 qualified bidders and 13 qualified bidders for a relatively small, that happened to be a pedo practice. But the reason I put this up here is to show you the difference in the EBITDA calculations as made by the bidders. So in client case study number 1, the bidders calculated the EBITDA with a range of $1.3 million in difference, which is pretty surprising. And again, there are different ways to calculate EBITDA. In this particular case, it was what they used as compensation for the doctors. So understand how EBITDA is calculated and understand that when an Invisible DSO is doing the calculations, they're not doing it to your benefit. Both of these transactions went to the same trifecta bidder, and they both went at over 10 times EBITDA. Here's some other case studies. I wanted to show that not everything's in Florida. And again, multiple bidders, high EBITDA values. Case study number 5 was actually done in 23, not 24 or 25. Here's some other examples across the country, and we'll talk a little bit about geography in a second, but just because you're not in Texas, Florida, Tennessee, Colorado, Idaho, Utah, Arizona, doesn't mean you can't get a great value. One of our best deals last year was for a GP practice in Michigan at over 10 times EBITDA, not a particularly big one. And so there are now more bidders today that are looking at states outside of the hot states for great doctors that are growing and are relatively young. Now, what practices will qualify for high value Invisible DSO partnership? And this is important to understand. Typically, we do not take clients that have an EBITDA of less than $500,000. And remember, That is based on after doctor compensation, meaning your EBITDA after paying you. What is your business profit? And the answer is the invisible DSOs don't start paying attention and don't start paying real multiples until your EBITDA is at least $500,000. And the practices that draw the most bidders will achieve the highest values. And drawing the most bidders is not necessarily a function of your EBITDA or your location, but it's about you. These groups are buying you. And so they're looking for doctors that have a personality, a passion for dentistry, and a plan for growth. And doctors who have all three of those elements are going to get higher values than the doctors that don't have those three elements. And it makes a big difference in value. In some cases, millions of dollars in value because the doctor was charming, witty, and talented. I don't know. Certainly your clinical skills matter, but your personality and your ability to interact with your potential partners in the various live meetings that you'll have is really important. We did a deal in 23 for a 39-year-old doctor at over 14 times EBITDA, and it was his personality, his presence, and his plan and his passion that got him to 14 times EBITDA. Certainly, he had a great EBITDA and a great practice, but it was his personality that got him that multiple. So don't forget, you're the most important part of this transaction, not necessarily your numbers. Now, keep in mind, every one of these transactions is custom. There are really not many cookie cutter buyers out there. They are eager to work with a doctor that they like, that's in a geography that they like. And so they're going to customize a plan that fits for you. We are doing a deal for a 70-year-old pediatric dentist who has multiple younger associates. But in her case, she's going to have a relatively short time frame. She's not going to work 5 days a week. She's not in the mouth. And she's using part of those proceeds to buy out her partner. So there are a lot of different ways to structure these transactions. And I urge doctors who are about to give or sell ownership to their associates to come to me first and understand what the value of your practice is before you sell an interest in your practice at a value that's too low. We see that on a regular basis, and that's good for the associates, not necessarily good for the owner doctor. So typical deal, and keep in mind there is not really a typical deal, but a doctor is going to sell 51 to 80% of the value of their practice for cash up front. The multiple will be, we haven't done any 5X deals in probably 5 years, but it's going to depend on the size of the practice, the growth rate, the age of the doctor, and that's going to dictate the multiple. I would bet that the majority of our practice transactions this year will be done at somewhere between 7.5 and 8 times EBITDA. You're going to get cash up front for the percentage of your practice that you sell. That cash will be taxed at long-term capital gains tax rates of 20% federal maximum, plus whatever your local governor is taking from you. You're going to sign an employment agreement, and that employment agreement will outline how many days a year you're going to work, not what days of the week or what days of the year you're going to work, but just the number of days. And you're going to be still an owner. And that owner may be in the practice or the parent, but you're still an owner. You still have skin in the game, and that's what's important. So let's see if I lost my arrow. There it is. Okay, ideal doctor practice traits. Again, passion, personality, plan for growth, a doctor who desires a partner. We have some doctors who go through this process, and at the end of the game, they decide, I really don't want a partner, which is great, but let's learn that beforehand, so before we waste each other's time and my money on trying to find you a partner when you decide at the end of the game you don't really want a partner. That's okay. Let's just discover it early. Doctors that are eager for equity and understand the opportunity in the equity is important. Doctors who want to stick around for at least 5 years are more valuable than those that do not. And we do plenty of transactions for doctors who do not stick around for 5 years, but it's typically in multi-doctor practices. They're looking very heavily at your team turnover today. Practices with lower team turnover are going to have higher values than practices that have a revolving door of staff members. If you're in a growing population, that's a plus. It's not a requirement, but it is a plus. Your facility is important, but it does not have to be state-of-the-art 2025. At least being in this century will help. But it's not really a driving factor as to how expensive, beautiful, and fancy your facility is. They're far more interested in the doctor's personality, passion, and plan than they are your facilities. So sorry for you guys who just spent $1 million redoing your office. Now, when should you consider invisible DSO partnership? And the answer is that's very personal. For some doctors, they should have considered it 2 years ago before they turned 60. And for other doctors, they may never consider invisible DSO partnership. But timing is important. There are special situations that come up, and we'll call a doctor in a city and say, hey, we've got 3 other clients in your neighborhood, and we have a great invisible DSO that's eager for density. We ought to have a conversation because I may be able to get you a value 25% higher in this transaction than you might get elsewhere. Let's have a conversation. So timing really starts with, I urge every doctor who's qualified to contact me, chip@largepracticesales.com, and let's schedule a time to have a conversation. And if you want, we can go through the process to tell you what the value of your practice is today. Doesn't mean you're obligated to do anything, and we get paid nothing for that, but it pays to have a benchmark value, if for no other reason than for us to be able to tell you, hey, we evaluated your practice, your EBITDA is X, we think your expenses are out of line here, here, and here, and you may have an opportunity to do XYZ. So we do not pretend to be practice consultants, and we don't get paid to do it, so we don't do it. However, going through the valuation process can be very illuminating. We've had clients that became clients 3 years after our first valuation because we gave them some pointers on how they could improve their practice and increase their EBITDA and therefore increase their value. So don't be bashful. Give us a call. Let's go through the value of your practice. But timing can often be important. For those of you not paying attention, the world is a little scary out there today, as you saw in my earlier slides. And now may be a great time to gain liquidity, reduce risk, diversify your personal portfolio, because for many of you, your practice is your largest personal asset. And to give you a sad story, you are one heartbeat away from your practice being worth a lot less than it could be. We had a great client of ours who, when we first met him, could have gotten $40 million for his practice. He did not get associates as we suggested that he did. And he ultimately became a client. We managed to get a deal done for him at $12 million, $28 million under what we could have gotten for him 2 years before. He had terminal cancer and passed away in February. So he was 47. So keep in mind, things can change, and you may owe it to your family, because life insurance is a wonderful thing, but disability insurance, which effectively takes you out of the chair and out of leadership, doesn't pay very well. Now, COVID earnouts. COVID earnouts are really the best thing in these transactions today, in that COVID earnout will pay you for the performance in your practice in the 2 years after your initial partnership. And it's very linear. Let's say you had $1 million of EBITDA day one, and a year later, your EBITDA has grown to $1.1 million. You're going to get paid for that $100,000 increase in incremental EBITDA for year one, and you do it again in year two, and you're going to get paid again at the end of year two. So doctors who tell me, nah, I'm going to wait 6 months to get my EBITDA up and then we'll talk, that's a mistake. Because if you're planning to do anything in the next 2 years, doing a deal today, you're going to get paid for the next 2 years of your growth. So I wouldn't wait. Keep in mind, initial values change weekly. Believe it or not, as crazy as that sounds, I'm going to use the Arizona, Colorado example. An invisible DSO, big one that we had done $200 million of transactions with in the prior couple of years, came to us in September of that year and said, hey, we promised our board we'd be in Arizona and Colorado by the end of the year. Do you have any practices that are clean enough and organized enough to get a deal closed by December 31? And if you do, we're going to pay a higher value. And so we did a great deal for practice in Colorado Springs. They probably got 25% more than they would have gotten otherwise. And we did one in Phoenix, and that solved the invisible DSO's promises to their board that they would be in those two states by the end of the year. And our clients benefited because we knew that. And so we got them 25% premiums over what they would have gotten anywhere else, only because we knew the right buyer at the right moment in time. We did a similar thing in the Northeast, where we had 5 clients that saw the value of their practices grow from 7 to 9x just because similar situation management had promised their board that they would be there. Structure for taxes is important. All of these transactions are typically asset purchases. Therefore, the calculation of tangible assets versus intangible or goodwill are extremely important. And in the last $1 billion of transactions, 94% of our clients' cash they received was taxed at goodwill or intangible rates, therefore long-term capital gains tax rates. That's a really important piece of the transaction that you need to negotiate up front. So be careful. Now, if you own your own building, 2 great outcomes for you. Number one, you now have a AAA credit tenant in your building, and you have 2 options. One, you can collect rent from your AAA credit tenant for the next 15 years and structure the lease correctly with the CPI escalator. And number 2, because of your new tenant, you now have the ability to sell your real estate to any one of the 15 real estate investment trusts that are eager to buy real estate occupied by invisible DSOs because of the credit quality of the tenant. Not that you're a bad tenant, but a AAA credit corporate entity is a better tenant. And therefore, the value of your real estate in these transactions will increase. Now, beware the blacklist. This is the scariest thing in the invisible DSO business. You need to understand and do extraordinary due diligence on the people that you allow to bid on your practice, because there are a number of scam artists out there today, and that number is growing. And there are actually invisible DSOs going to doctors and saying, no, we're not going to give you any cash, but we're going to give you all of this magic paper, and it's going to be worth a fortune later on. There are a lot of groups on the blacklist for a bunch of different reasons. One of the largest invisible DSOs in the US is on the blacklist today because they are currently looking for their 3rd CEO in 2 years. And so we certainly are not going to partner our client with an invisible DSO that doesn't really know where it's going because it doesn't have a CEO. The other thing to look at and make sure they have it is the right investors. There are invisible DSOs out there today that are financed by groups that have built 2, 3, 4, 5, and we helped an investor form their 9th invisible DSO with one of our great clients. That particular group had already monetized 6 of the invisible DSOs that they started and returned over $4 billion to their investors and doctors in the prior 10 years. So you need to understand who the money is, where it's coming from, what their experience is. Do they have multi-site healthcare experience? And preferably, have they built other invisible DSOs in the past? My DIY slide. This is probably one of the most important. You do not want to do one of these transactions by yourself. These are complex. This is your life's work. You want to have multiple bidders. You are a smile expert, not a deal expert. I did not put the braces on my kids' teeth. I don't do my own root canals. All I know how to do is great IDSO partnerships, and you should not attempt one of these without an advisor. Now, obviously, that advisor should be large practice sales because we're the best. But even if you choose one of the little conflicted advisors that is getting paid by both the invisible DSO and by you, sometimes they forget to tell you that, get an advisor. These are complex transactions. This is your life's work. You want to end up happy. Sure, you can go with one of the little advisors and you may get less money and a less favorable deal, but these are important. You need to understand what's happening. And here's an example of doctors who came to us who tried to do their own deal. We said, let us help you. And this is where we ended up on these 3 examples. And this happens every month. Doctors pretend that they're investment bankers. I don't know when they studied for that, during dental school, maybe. But you don't want to do these transactions by yourself. Again, this is a slide about the scam artists. We won't spend too much time on this. But I'm of the belief that you deserve a specialist advisor that just does dental. There are plenty of little advisors out there who are struggling in dental right now. And so they have become med spa advisors or ophthalmology advisors or cardiology or vet or whatever. We have 35 people who focus just on dentistry, and we have our hands full. So the little advisors, again, are going to get paid by both the buyers and the sellers, which is why they're going to quote you a fee lower than ours. The challenge with that is you're only going to get to see the bidders that will also pay them. In our world, we don't get paid by the bidders. We only get paid by our doctors. Therefore, our allegiance is to your success. Most commonly asked questions: freedom, schedules, supplies. The answer is you're going to discuss all that with the potential bidders long before you get engaged, and you'll understand what will change and won't change, because some things will change. And I can promise you that with the right impact, your team will be excited about this partnership, and you're still going to be the one who gets to hire and fire them. Now, I put this slide up here, and Bill thought this was an error, but the reality is I put this up here not as a forecast for the future of dental practice values, but just as a reality check of what can happen to values. So in this example, the average veterinary practice market multiple declined by 30% over less than a 3-year period of time. Not saying that's happening to dental, but I can tell you it's happened in other industries. So the process to discover the potential value of your practice is pretty easy. If you've got at least $1.5 million in collections and you're a specialist, or $1.8 million in collections and you're a GP, give us a call, email me, Chip at Large Practice Sales, or go to largepracticesales.com, and then we'll schedule a 20-minute call between you and me, and we'll have a conversation and learn a little bit about each other. And worst case, I promise you, you will learn something. And if you decide you want to, we'll go through the process to tell you the value of your practice, the number of bidders that I think are possible. And worst case, you'll learn a little bit about your local market. It's not that painful of a process, and I think it's worth going through. And this is how you get hold of us. And Bill, I know we have some questions.
Yeah,
Thank you,
thanks.
Doctor.
That was great. Yeah, we'll leave the screen up here because if anybody wants to contact Chip, and it is you, Chip, right? You're the one
Yep.
that has the call with them.
Yes, sir. Absolutely. Only me.
Uh, I'm really curious, and this came in from somebody as well. The single office that went for $62.5 million. Can you tell us a little, as much as you're allowed to tell about that? Because that's pretty impressive.
It was. And the shocking thing is it was in less than 5,000 square feet. And the reason it brought a high value is because it had extraordinarily high margins. They were a dentist to the stars. I would bet their average case fee or average spend by their patients was somewhere north of $100,000 a year. I could list some of their patient names, which I won't, but everybody on this call would have heard of these patient names. So high value practice, right place at the right time. Interesting story of how we got that deal done and why, because it should have been undoable because the senior doctor was 73 years old. But we knew the right group that needed something in that location at that moment in time.
Let's see. I've got another one. Somebody has asks. I hope we can get a recording of this. Too many notes to take. Thanks. Yes, you will be able to get a recording of this. That's yeah. There's a lot of great information here. A couple more because I know we started a little late and we're going to run over here. So can I get you for like another minute or two, Chip? Is that
You
good?
can have me as long as you want. This is my favorite topic.
That's good. Well, you know enough about it. Question about how difficult is it to pull money out once there is an equity event? So just, I guess, being able to take some of that equity out once you're able to. Is it pretty
You know,
much like, is it
it,
different from deal to deal?
Yeah, it is. It's different from deal to deal, and it depends on what the doctor wants. Again, as I think I said earlier, that you can structure a deal such that you have a guaranteed exit of your equity at a set date and time in the future. That's perfectly doable. You don't have to wait for a recapitalization, and you can set up a structure such that the doctor can monetize 100% of the equity that they retained. Now, they're going to have less upside in that equity than the doctors who chose to let it ride, so to speak. But you can absolutely have a defined exit at a defined point in time.
So as far as deal structure goes, can you kind of go over maybe what you currently see as far as how much is upfront with cash, how much is equity? Is the equity at the practice level? Is it at the DS at the top co? How does that all work?
So the answer is doctors in our process will generally have three choices in general. Option number one, let's say your practice is worth $10 million and you decide you're going to sell 60% of your practice and keep 40% at the practice level. So you're going to get $6 million in cash at closing at long-term capital gains tax rates. And you're going to still be a 40% owner in your practice, which means you're going to get 40% of your practice profits paid to you either monthly or quarterly. So that's option number one. Option number two is instead of betting only on the success of your practice, you're going to become a shareholder in the parent company such that you are then betting on the success of the overall group, not just your practice. And in that case, you will no longer get distributions from your practice because the group owns 100% of your practice. And option three is a combination of both, where the doctor keeps some practice level equity and takes some parent level equity. So they're getting a combination of current profit distributions and the upside of parent equity. But most of our clients will have all three of those options to consider in our process.
Do one more question here, and there are a couple of others I don't think we'll have time for, but Chip would be happy to answer these offline. I'll give him a copy of all this so he's got access to the questions. And there were some that actually came in from registrants ahead of time that we pretty much got to most of those. Chip, thanks for doing that because there were
Thanks for giving it to me. Brilliant idea. Brilliant
quite a
idea.
few. Um, when you're taught yet you're having discussions all the time, right, with these different practices, whether it's one location or whether they have multiple locations or a small group, what are you hearing from them as far as you know patient activity, treatment acceptance right now? Or is it a mix? I mean, are some up, some down? What are you hearing?
It's all over the map. Ortho saw 8% case start decline 22 versus 21, 6% decline 23 versus 22, 5% decline 24 versus 23. So if you're a growing ortho practice and bucking that trend, you're very valuable. All on X is something that the invisible DSOs are getting a little nervous about. They are all forecasting a recession. And if you have a recession, there are going to be fewer people paying $25,000 an arch for an all on X case. The other challenge in the all on X business at the moment is there are some groups out there that are marketing full arches at $9,000 an arch. And so that is hurting some of the groups that are at $25,000 an arch. So, as a general rule, I think our doctors are nervous, but they're not seeing any broad decline. They're seeing some higher cancellation rates, which I would guess in many cases are financially driven. But at the moment, I would call the market nervous. I would not call it necessarily down, except in ortho. But it's going to be interesting. I think the next 90 days are going to be very telling, especially what's going on in the Middle East and what's going on with tariffs and what's going on with interest rates. A lot of people would like to see interest rates down when in reality, if you look at the 5-year US Treasury today and the 30-year US Treasury today, they are actually yielding more than they did a year ago, which means long rates have actually gone up. So it's people are nervous, as they should be.
Yeah, I think this is it's a great time though for docs to reach out to you now and really just try and figure out what the value is, what the opportunity is. This may be the time. And like you said, I think, we get people that reach out to us and a lot of times they're, in their 60s or should have or need to spend a couple of years building their business. They're on the decline already, and that's not the position that you want to be in. So I think it's reach out to Chip. This is great information. Yes, we will have a recording. It'll be up on our website tomorrow. And also, we'll send out an email to everybody that has attended and just give you Chip's contact information You have access to their webinar library, their podcasts, and Chip has a couple of great articles that he's done for us on our website. We'll link to those too. But thank you, Chip, and thank you everybody for spending some time with us. Sorry, we got a little bit of a late start there, but I sure hope this was worth it because a lot of great information. And I think you're really realistic, Chip, with what you're saying. You definitely don't want to do it on your own. And I know we get people that try to do it on their own and inevitably, in some cases, get taken advantage of.
True. So, biggest risk to practice values today are declining collections. If you get into a situation with declining collections, we can't help you. So, be careful.
Sounds good.
Bill, I appreciate your time. Thanks for having me.
Yep. Thank you, Chip. And again, thanks everybody for tuning in. And we will make sure this recording is up on the website and reach out to Chip and we'll have his contact information available for you.
Thank you, doctors.